Welcome to This Explainer. Today, we're diving straight into the absolute, true, hidden numbers behind the ultimate real estate debate. And we're going way beyond the standard thumbnail advice you usually see. Look, the problem with every rent versus buy debate you've ever watched is that both sides leave something major out. The homeownership side, they always lead with the ending, showing you what a house is worth in 20 years and basically calling it proof. The renting side, they lead with flexibility and freedom and pretend that lifestyle has absolutely no longer-term cost. Well, today, we are running the real math on both. So let's kick things off by completely dismantling this classic myth. Is renting really just throwing your money away? We're going to look at exactly what happens if a renter actually takes the discipline to invest the money they aren't spending on a mortgage every month for 20 solid years. By the end of this, you are going to know exactly which situation makes buying the clear winner versus when renting is actually the smarter play. All right, Section 1. Meet Jake and Marcus. Picture two identical 32-year-olds, Jake and Marcus. They live in the exact same mid-sized city, they both earn $80,000 a year, and they both have exactly $70,000 sitting in the bank. But they're taking two completely different paths. Jake goes all in and buys a comfortable three-bedroom home for $350,000. He puts his full $70,000 down, which is exactly 20%, perfectly avoiding private mortgage insurance. On a 30-year loan at a 7% interest rate, plus his property taxes, insurance, and a baseline maintenance budget, his total monthly cost to own is $2,653. Marcus, on the other hand, spots what looks like a loophole. He rents a nearly identical home in the same neighborhood for just $2,000 a month. He takes his $70,000 and drops it into a total stock market index fund, and, crucially, he invests that $653 monthly difference. Section 2. The Year 1 Reality Check. Because, man, the reality of signing that mortgage, it is about to hit Jake like a ton of bricks. The real estate industry rarely advertises what happens on day one, because quite frankly, it makes the first year look pretty terrible. Here is the hidden number nobody talks about. Thanks to lender fees, title insurance, attorney fees, and prepays, Jake is instantly behind at the closing table. I mean, closing costs on a $350,000 home generally run between 2 and 5%. So sure, Jake paid $70,000 to get into this home, but his real day one cost is instantly ballooning to somewhere between $82,000 and $88,000. That is a massive gap that has to be recovered before buying even begins to make financial sense over renting. And just look at how this brilliantly illustrates the year one reality. Jake isn't really building equity right out of the gate. He's actually throwing away a staggering amount of money. In year one of a 30-year mortgage at 7%, out of his $1,863 payment, roughly $1,633 goes straight to the lender as interest. Only $230 measly dollars goes toward reducing his actual loan balance. When you add in taxes, insurance, and maintenance, Jake is throwing away $2,623 every single month on costs that build absolutely zero equity. Meanwhile, Marcus is throwing away $2,000 a month on rent. So in year one, Marcus is actually throwing away less. Okay, let's fast forward to year 3. Check out the scoreboard. Marcus is actually slightly ahead in liquid net worth, all without having to worry about replacing a broken water heater or patching a cracked wall. Marcus's original investment plus his religious monthly contributions have grown his portfolio to approximately $120,000. Jake, meanwhile, has between $111,000 and $124,000 in equity. Now, that is real wealth for Jake, for sure, but it is entirely locked inside the walls of a house. He cannot sell it without paying hefty commissions on the way out. Marcus? He can access his portfolio any business day he wants. Section 3. A decade of hidden costs. So before we even hit year 10, we absolutely have to talk about the friction that drags both of these guys down. There are costs that almost never make it into those optimistic buying spreadsheets. Homeowners have to clear this massive hurdle called transaction drag before their investment actually performs. You see, when Jake eventually decides to sell, he'll pay a seller's commission of around 5 to 6%. Combined with the costs he paid going in, that is an 8 to 10% total drag on the home's value over a full cycle.
Plus, as the home appreciates, property taxes grow right along with the assessed value, meaning his total housing cost will undeniably rise over time, even with a fixed mortgage.
And then, oh boy, there's maintenance. Jake's cute little $290 a month maintenance budget looks perfectly fine for, caulking and light bulbs, but then reality hits with massive, unavoidable bills that act like a ticking time bomb. Reality looks a lot like $9,000 roofs, $7,500 HVAC systems, and $4,000 foundation repairs. A homeowner who doesn't aggressively set aside cash for these things is literally just borrowing time against a bill with a due date that never gets announced. But wait, we absolutely cannot ignore opportunity cost here. By sliding that $70,000 down payment across the closing table, Jake traded away staggering compound market growth. The exact moment he wired those funds, they were gone from the market. To put that into perspective, at a 10% average annual return over 20 years, that same money would have grown to approximately $470,000 in an index fund. That is the massive alternative outcome Jake traded away just to get home equity. Boom! Year 10, Marcus's portfolio is sitting pretty at about $291,000, which is actually beating Jake's equity of around $245,000. But there is a major shift happening right now. Marcus's rent has climbed by 3% annually and is now hitting $2,690. He is paying nearly as much as Jake every month, completely erasing that awesome monthly savings advantage he used to have, and absolutely nothing is building underneath his rent payments. Jake's principal and interest payment, it is locked in and fixed for 20 more years. Moving on to Section 4, the 20-year finish line. The timeline finally converges at year 20. And this is where the compounding forces on both sides really show their teeth. The numbers here are going to surprise people on both sides of this debate. Marcus's liquid assets are actually still slightly ahead of Jake's equity, coming in at roughly $550,000 to $580,000. But Marcus is now suffocating under a $3,600 monthly rent bill. Jake has roughly $500,000 in equity, but his core housing cost has stayed relatively anchored. Marcus's cost advantage is entirely gone. And worse, his rent has absolutely no endpoint. But then we hit year 30. And while the math just violently flips, Jake's mortgage ends. Done. His monthly costs plummet to roughly $900 to $1,100 just to cover taxes, insurance, and maintenance. And he outright owns a home worth roughly $900,000. Marcus, on the other hand, is staring down an endless, escalating cost of living with absolutely no floor in sight. His rent has ballooned to somewhere between $4,700 and $5,000 a month. Which brings us to our final part, Section 5, the ultimate wealth decider. Look, we've stared at the spreadsheets, right? We know exactly how the math plays out. But now we have to expose the massive, gaping psychological trap that absolutely ruins the renter's math in the real world. The renter strategy works incredibly well, but only if you possess the robotic discipline to invest every single dollar of that cost gap, holding steady through every terrifying market crash. When the market drops 30% and every human instinct is screaming at you to wait it out in cash, you still have to invest. The data shows actual renters rarely do this. What happens? They spend the difference. They upgrade their lifestyle, they take the nice vacations, they move to a slightly nicer apartment. See, buying a home enforces automatic savings every single month. That forced discipline is the real, unquantifiable reason homeowners so often end up wealthier than the theoretical numbers predict. You literally don't have a choice. You have to pay the mortgage. But we also have to remember the very real risks of buying. Mobility is incredibly expensive, and your entire net worth can get completely concentrated into one single building on one single street in one single zip code. Okay, so let's translate all this theory into something you can actually use today. To figure out which path is right for you, you need to calculate your local price to rent ratio to see exactly what the numbers dictate in your specific zip code. It's super easy. You simply take the purchase price of the home you want and divide it by the annual rent for comparable property. So when does buying take the crown? It's the clear, undisputed winner if you're planning to stay put for at least 7 to 10 years.
Why? Because the transaction costs stop being such a drag, and that fixed payment becomes a massive long-term advantage. It also wins if your local price to rent ratio is under 20, or if your rent is already creeping up close to what a total mortgage payment would cost anyway. In consistently appreciating markets, the leverage you get through a mortgage accelerates wealth way faster than pretty much any equivalent portfolio position.
On the flip side, renting absolutely dominates if you're itching to move in the next 3 to 5 years, because the transaction costs alone will likely leave you way behind. It also wins if your local ratio is above 25, and, this is the big one, you genuinely have the ironclad discipline to invest consistently. Plus, if you're in a career phase where mobility creates meaningful income growth, the flexibility premium of renting has real, tangible economic value that spreadsheets just cannot capture. I'm going to leave you with two massive questions to chew on, because at the end of the day, your honest answers to these are the ultimate wealth deciders. First, how long are you actually planning to stay? And second, if you rent, are you honestly, truly going to invest the difference? The math, the head-to-head comparison, that crazy year 20 outcome, all of it depends on what you actually do, not what you plan to do. So which path are you truly equipped for?